Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. We've titled this monthly update 5 Years, 5 Stars for two obvious reasons. The first is that DBMF launched in May of 2019, passing its 5-year anniversary recently. And second, DBMF has received a 5-star rating from Morningstar as of the end of the quarter of this year. It's worth noting, though, that the strategy actually has a live track record going back further than that, as it started in 2016 as a separately managed account, which was converted to the ETF vehicle in 2019. We're very happy to provide that longer data set upon request to clients and to prospective clients. So it was a strong month in June for DBMF on top of what's been a strong year and a strong overall history, which we believe is a must-have within the alternatives allocation of portfolios. Andrew will touch on positioning and attribution in this update as usual, alongside further thoughts and color on macro drivers of outperformance and how we look to deliver that with consistency over the long term. So with that, Andrew, I hand it over to you.
Thank you, Mike. And as always, thank you to everyone for listening in. In June, DBMF gained around 2.3% net and is up 18.3% net on a price basis for the first half of 2024. This year, we're outperforming the SocGen CTA index, here and after the hedge fund index, by approximately 1,000 basis points, and the Morningstar US Trend Systematic category, here and after the Morningstar category, by slightly more. As noted in the second bullet, this year has been a case study in the idea that sometimes simpler works better. As we'll show in the next slide, non-core positions, the kind we don't trade, have meaningfully detracted from performance of actual hedge funds and their mutual fund kin. So replication is working as expected, or maybe even better than expected, by picking up the core positions while sidestepping idiosyncratic losses. Since inception of DBMF just over 5 years ago, we've outperformed the target hedge funds by over 300 basis points per annum and doubled the annual performance of the mutual fund equivalents, all by simply aiming to replicate the pre-fee returns of hedge funds and charging less. More stats on this in a few slides. On the macro front, the markets feel a bit fragile. The economy appears to be slowing, but inflation remains sticky. The macroeconomic and sociopolitical backdrop is alarming, but the AI train keeps marching on nonetheless. So equities had a stellar first half, or rather, I should say, a handful of stocks had a ridiculously stellar first half, but bonds are still down for the year and underperforming cash. The truly concerning thing for allocators, as we've discussed at length, is that bonds stopped functioning as an effective hedge against equities a few years ago. And it's slowly dawning on people that the world has indeed changed, and this is rippling through asset allocation models. Clearly, this is part of the DBI drumbeat, where we think DBMF can fill some of that diversification gap. But first, let's talk about year-to-date performance. So this slide shows year-to-date performance of DBMF versus the SocGen CTA index and the Morningstar category. The first observation is that the replication has maintained a high correlation all year long. The second is that the performance gap widened in May and especially June. So what explains the gap? As noted, it's primarily due to avoiding a number of positions, the Mexican peso, some commodities, a few European equity markets, etc., that have been whipsawed due to idiosyncratic factors. So to take a step back, most of the time, there will be some winners and losers among these non-core positions, and hence replication tends to outperform due to fee and expense disintermediation. Rarely, a high percentage of non-core positions work well at the same time, and replication will underperform by a bit. January and February of 2023 were great examples, and we talked about this extensively in our performance updates back then. Other times, a high percentage are getting whipsawed, and replication will outperform by more than simply fees. We've seen this many times before, and given the high correlation to the target funds this year, we chalk up the outperformance to a combination of fee and expense savings, avoiding losing positions, and noise. Because of this, we also conclude that there's also no reason to believe the outperformance will somehow revert. And by the way, here's a fascinating validation of what we're talking about. Driven in part by the success of DBMF, some of our competitors from the mutual fund space have launched quote-unquote simpler strategies and ETFs. In both cases, the simpler ETF is outperforming the more complicated mutual fund this year. These performance comparisons will hopefully foster a healthy debate about when complexity aids performance and whether it justifies higher fees over time. Next slide. So to build on this, as Mike mentioned, we hit a huge milestone in May, the 5-year anniversary of the launch of the ETF. So I thought it appropriate to at least add a slide on comparative performance versus the target hedge funds and mutual fund ETF peer group. The short answer is that DBMF has outperformed the target hedge funds by over 300 basis points per annum with a correlation of 0.9. DBMF has outperformed the mutual fund ETF peer group by over 500 basis points per annum, which explains the 5 stars on Morningstar. Granted, our volatility is modestly higher, which is to be expected when you're trying to replicate hedge fund returns before incentive fees, as is our max drawdown, which was due to a combination of giving back outperformance from the peak in 2022, followed by a period of underperformance last year. But all in all, if there's a better way to get something that looks like index plus exposure to the space, we haven't found it. Next slide. But the real reason people invest in DBMF is for diversification. And hence, here is our regular chart on stocks, bonds, and DBMF. Since inception, DBMF has returned about 10% per annum on a price basis, with negative correlation to both stocks and bonds and over 1,000 basis points of annualized alpha to equities. When we look at the stat relative to the broader liquid alt space using Bloomberg data, it looks like DBMF ranks among the top 1 to 2% of liquid alternative products since inception, and that does not include all the funds that were closed since we launched. And by the way, many of the funds with the highest alpha generation are in fact managed futures mutual funds, which makes us increasingly confident that in a few years, the question will not be whether to add managed futures as a diversifier, but simply how much. And our goal is for DBMF to become the straightforward default allocation to the space, an access point for investors who seek index plus exposure. Next slide, please. Here is our slide on volatility adjusted positioning. The red dots are from the end of May, and the green dots are at the end of green bars are as of the end of June. Starting on the left, we've maintained long exposure to both crude oil and gold. In currencies, we kept our short position in the Japanese yen, which has been the gift that keeps on giving for trend followers. But note that we flipped to a long position in the euro. On the rate fronts, we're now more confidently short across the curve, a position that I like, given that the elephant in the room is that we have 2 political parties that seem to have forgotten any sense of fiscal prudence, so which begs for a bond market tantrum at some point. Lastly, we continue to dial back long equity exposure after ramping it up in the first quarter. So overall, I see a portfolio well positioned for any upward surprises on the inflation front, but with an interesting bias also for a rebound in Europe. Which brings us to the next slide. So here's our contribution by factor. The first thing to note is that we've made money in 3 or 4 asset classes, commodities, currencies, and equities, and have been flattish in rates. And clearly the yen stands out as a spectacular winner, and I believe is a case study in alpha generation by trend followers. The competitive advantage of trend following is that the models do not have the heuristic biases that can trip up even the best investors. So how many macro investors took profits before the recent move to 160? How many were shaken out by periodic jawboning about intervention? How many were anchored to prices close to 110, which is where it traded for years? So the yen trade is an example of alpha generation outside of a crisis period, simply an idiosyncratic contrarian trade that has generated outsized profits. Of course, at some point, the opportunity will end, and managed futures will then dial back their exposure. But when something is working, they don't overthink it, and that can be a real strength. To move to the rest of the portfolio, on the right, you can see the gains on equities. As noted, CTAs dialed up exposure quickly in the first quarter, then started to dial back once the markets got rocky in April, and today are flattish equities overall. So whereas the yen is an example of pressing a bet on an open position, CTAs made money in equities this year, market conditions changed, and they took profits. Then add gains in commodities, and we're having a great year. So with that, I'll hand the baton back to Mike.
Hey, thanks, Andrew. Appreciate it. Let's wrap here as we typically do with long-term performance comps, although it's a little bit redundant this month, but we'll do it anyway. And a side note on expenses in the category. So year to date, through June 2024, DBMF expanded its since inception outperformance against its key benchmarks quite a bit. DBMF is now ahead of the SocGen CTA index by over 330 basis points annualized, and ahead of the Morningstar systematic trend average by over 500 basis points annualized. And of course, our expenses, which are less than half of that of our Morningstar peer group, represent another compelling differentiating factor for DBMF and one of the key components that help deliver ongoing outperformance. In fact, the average expense ratio for the Morningstar category actually went up by 2 basis points this quarter over last. As we like to say, fee reduction is the purest form of alpha. So in closing, thanks as always to our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.